welcome to the fourth edition of the State and Local Tax Webinar Series presented by Frederickson and Byron in partnership with the Society of Minnesota CPAs. My name is Kyle Brame and I'm a state and local tax attorney with Frederickson and Byron. Together with my co-presenter today and my colleague Jenny Cush, it is my pleasure to welcome all of you here today. As I've mentioned in past weeks, we will be continuing this webinar series in the future. As such, I would like to encourage all of you to please use the evaluation which is available following the session to suggest additional topics you would like to have covered. We do take that stuff seriously, and as a result, we've been thinking through other topics to cover in the future. We have two additional sessions that we're developing at this time. First, Ken Levinson and David Tibbles will be presenting a session focused on the state income tax issues arising from international tax reform and the Federal CARES Act. That session will take place on June 11th at 2 p.m. Second, Masha Yevzelman and I will be presenting a session focused on state nexus challenges, both income tax and sales tax, and strategies to mitigate any potential liabilities resulting from nexus challenges. That session will take place on August 13th at 2 p.m. All of you as attendees of a past session will receive additional registration information for those two sessions as soon as they're released. Before we begin, a couple quick technical issues to discuss. All of your audio is muted throughout the session, but we encourage you to use the chat button at the bottom of your screen to submit any questions you might have. Also, the slides from today's presentation are available on the Frederickson and Minnesota CPA registration sites. This session is eligible for CPE credit and is eligible for CLE in both Minnesota and in Iowa. In order to earn CPE credit, you must respond to the polling questions taking place throughout this session. I would like to again take a moment to thank the Society of Minnesota CPAs for their partnership in offering this webinar series, and a quick thank you to Jenny for joining me here today. Finally, I would like to thank all of you, our attendees, for taking the time out of your day to join us. With that, let's take a moment to go through today's agenda. So, to those of you who know me and know me well, audit defense is an area that I get particularly jazzed up about, and there's a lot of different issues we could potentially cover here. That being said, what we've tried to do is select a number of issues that are either novel or, to the extent that they're old, growing in importance today. So our agenda is really going to focus on starting with accounting-based audits, moving through third-party shipments, some reporting royalties issues, going back to an oldie but a goodie and exemption certificates and other documentation issues. Jenny thought it was critical that we handle bars here, so in the spirit of being in the week that featured Cinco de Mayo, we'll hit on indirect audits, and then we have a number of just miscellaneous items to conclude with today. And with that, we will move on to our first polling question. So our first polling question asks, what type of organization do you work for?
Polling will end in 5 seconds.
All right, so we have as everybody can see from our polling results, we have a mixed bag of different people in attendance. And again, thank you all for joining us, regardless of what your experience is or your current employer. Looking forward to it. All right, so our first topic today is on accounting-based audits, and this is an issue that we're seeing more and more attention given to in the audits that we're dealing with. There's a couple different issues that happen here. First, and the one that to me has resulted in the largest issue for some taxpayers is when you have companies who are using shared purchasing accounts for items that are used across the organization. So for example, if you are a retailer and you're purchasing shelving, you purchase all of that into one share account and then allocate the expense in that account out more for accounting purposes or for cost accounting purposes to the actual locations around the country, either that are using it or you just allocate it given a kind of business methodology to make sure those expenses are being tracked. The same kind of things happen a lot of times with advertising expenses, things of that nature within an organization. Well, Importantly, the transactions, the actual purchases of those items, whether it be the shelves or the advertising or whatever, have tax on the invoice, or oftentimes taxpayers are self-assessing on the original purchase of those original purchase transactions. But then when those purchase transactions are actually being allocated out of that general account to the actual locations that are putting these to use, what we're seeing is it's very difficult to track the tax that was already paid on those transactions. So auditors were keying in on those journal entries, the actual allocations out of those shared purchasing accounts, and saying, show me the tax that relates to this journal entry. So a hypothetical example, if you have a $10,000 purchase of shelving that hits a general account, and that's allocated out to 1,000 different locations around the country, you see a $10 charge for that, and auditors want to see a $10 charge with corresponding tax, which results in issues for taxpayers who don't have the documentation to kind of track through what the original tax was paid on those invoices hitting that general account as it's been allocated out. So we're also seeing other, and this is maybe the most egregious issue I've seen, is that taxpayers who are reporting gross sales accurately on their returns and also reporting taxable sales, some auditors who will say maybe aren't the most motivated or accurate are just going after gross sales as a number and trying to tax that delta. Now, obviously, if this is something that's happening, it should not be happening and should be able to be resolved relatively quickly. But given your level of documentation, that could be something that presents difficulty. Otherwise, some things we're seeing, GL accounts. So just because you have an account set up in your general ledger, that does not necessarily mean that that general ledger account is active or being actively used within a state. So auditors pushing and saying, that general ledger accounts that don't show any use is evidence of some spending that isn't being disclosed is just simply not true. So who's at risk in this area? Obviously, companies that are using these kind of corporate company-wide accounts to purchase and then allocate spend are at risk. Taxpayers that are using accrual-based accounting, we especially see that happening for those types of taxpayers. And then just frankly, taxpayers who provide too much data or too much information to their auditors are at risk here. So what do we do about it? How do we mitigate the issue as it relates to these types of transactions? The first thing that we've listed here, and this is normally where I might roll my eyes if I were presenting in a live environment, but organizational changes. So if your organization is going through accounting procedures that rely on reporting everything into one GL account or several for that matter, and then allocating them out through journal entries, and you have the power within tax, which is not often the case, but if that's something you do have the power to change, potentially leveraging that power to be able to change the way in which you're recording those transactions, because that's something that does present difficulty. Now, acknowledging the fact that oftentimes tax doesn't have the power or authority to change the way in which accounting processes work within an organization, oftentimes you have to think about other ways in which we can resolve the situation. So one thing that I often point to is just limit what data you are providing to your auditors. Some companies that I've worked with historically, I just flat out refuse to provide journal entry information to auditors as part of the review. Journal entries are not transactions in the sense that you're purchasing something from a third party. So if to the extent that you're able to limit your data set that's being provided to an auditor, that's obviously something that can quickly resolve these issues. Limiting the data to state relevant GL accounts. Again, depending on how the conversation and how the startup of the audit has gone, this is something that may be more or less successful. Other things to think about, the use of technology. So as we consider the issue where you have a general purchasing account or a transaction type specific purchasing account that later gets allocated, the difficulty is in showing how much tax was paid on that specific allocation. One area that we've worked with taxpayers to, resolve that issue, to help resolve that issue as part of an audit, is to develop processes using technology, so systems like Alteryx or other ETL programs, to help tie the original purchases and the tax paid thereon to the ultimate journal entry. So rather than showing an auditor at the onset that there's a $10 journal entry with no tax, showing them that there's a $10 journal entry that had, an allocation of use tax of 67 cents. As you're able to utilize technology to put together data that is helpful in responding to auditors, that's something that can really streamline the way in which an audit's handled and help mitigate some of the risk associated with that. And then I would add, it doesn't just matter for your current audits, it can also impact future audits. So as you're putting those types of processes in place to address an ongoing audit and to help mitigate the risk associated with that audit, consider whether those same processes can be put in place on a monthly basis to track exactly what tax was paid on that allocation initially, whether it was use tax or sales tax, and track that on a monthly basis. So now you have contemporaneous records that were stored throughout time, that when your audit is kicked off in the future, you can pull those records and provide them to an auditor in a way that hopefully can help mitigate some of the risk associated with those accounting-based issues within the audit. With that, we will move on to our second polling question. Our second polling question asks, what has your company done to prepare for accounting-based audits?
Polling will end in 5 seconds.
All right, so we see, not surprisingly, a mixed bag of different responses to this question. This is an area in accounting-based audits that I think, to the point that I was just making on our past slide related to technology, this is an area where new technology is becoming available on a cost-effective basis for companies. So we're seeing more and more companies transitioning from not doing a whole lot in this space to starting to really do some things to preempt the issue. Now with that, we'll move on to our next topic, which is third-party shipments. So the third-party shipments label, if you will, the issue really comes up in, where you have a third party that is shipping something, where does title transfer? And this comes up in a few different specific circumstances. It could come up where you have an export sale and your bills of lading might evidence where title transfers to those items, or it could come up within a situation where perhaps you have a purchasing agent who is making purchases on behalf of an exempt entity. Those are a couple areas where the tax answer may directly change as a result of things like where title transfers, where risk of loss, or who holds risk of loss and at what point in time. So the big questions, again, are, where's title, when is title transferring into whom, who holds the risk of loss, things of that nature. And those are things that are often defined within the contract between the different parties to a transaction. So bills of lading should show, for example, where title is transferring to a specific good based on the delivery method. Well, if an export sale transfers within the United States, transfers title, the tax answer for that may very well be different than if the title transfers outside the United States. So within the export or within the kind of purchasing agent space related to exempt entity transactions, there are some very different tax answers that come out of these situations based on the contractual terms that are at play and how that's documented. Now, this is coming up more and more, and I think a lot of this really comes up because auditors have become reluctant to accept the type of documentation that traditionally has been acceptable. Not to say that that isn't, good evidence still, or that bills of lading don't show the terms of the contract or the parties to the contract, that contracts don't have the right type of language in them. But especially as audit staff have become, we'll say, less and less experienced at at the audit examination level, oftentimes this presents a significant risk to taxpayers because they're providing information that was put together in good faith and traditionally was acceptable. And now you have auditors who are refusing to accept that, and I think often in part because the information that's being provided results in a taxpayer-friendly result or a non-assessment. So what do you know, in terms of who's at risk here, we've talked about a couple of specific examples, but I think in terms of, documentation, it's making sure that you think through the contract terms for those types of examples, and then put documentation policies in place to make sure that you have that in play at the point that these items come up on audit. Now, in terms of how do you mitigate the risk, I think really the best strategy here is the first approach you have, which map out the issue, figure out what facts are really in play, including where title transfers, who has risk of loss, those types of items. Really understand your facts, and then put those together in a way that you can properly explain the factual scenario to the auditor at the onset of the audit, so you're not fighting with them throughout the audit about the issue. If you can get them to remove these types of transactions at the onset of the audit versus trying to argue that at the conclusion of an audit, you're going to have much more luck just as a result of the fact that there's not a reduction in assessment that an auditor is seeing if it's something that from the onset they know that these transactions shouldn't be taxable. I would say review your documentation, understand exactly what the terms are within that documentation and how it relates to the requirements of the state that you're operating within. If you know your state, if you know the statutes of that state, how the courts have come down in that state related to some of these issues, and you know what your documentation says in relation to those policies, you're going to put yourself in a much better situation to resolve these issues early on and potentially throughout the audit. Finally, we talk about utilizing the department's chain of command, and this is something we discussed during, for those of you who were on our webinar last week, we talked about this a lot in that space as well. The auditor is not the end-all, be-all when it comes to an audit examination. They have lead workers and supervisors that they work with, so being willing to engage those different individuals and levels of review within the audit is something that can really cut in your favor. But I would say don't view the audit exam staff or for that matter, their lead workers, supervisors, et cetera, as adversarial to you until they actually are adversarial to you. Try to work with them to resolve these issues throughout the audit, escalate them when necessary, and have real conversations with them. Don't just rely on a communication from an auditor that they checked with their lead worker. Set up a conversation so you're not putting the audit examiner in a position of playing telephone or trying to translate a message you've told them to their lead worker. Get on a call with the lead worker, with the supervisor, et cetera, and have a conversation. Work through the other types of channels that are available. So, for example, you will have taxpayer rights advocates within the department that their sole job is to advocate on your behalf. So reach out to those individuals if you're having difficulty resolving an issue like this within an audit. And don't be afraid to contest the results that you get. Don't accept failure. You can have a conversation with the audit staff and their supervisors, taxpayer, and still not succeed at the audit level. Don't be afraid to contest those items through whether it's administrative appeals, the ALJ or tax tribunal proceedings, ultimately litigating them. And I think a point that we made last week that is especially relevant here is to make sure that you're putting together, if there's an issue that's significant and controversial, but you believe you're right on, make sure that you're putting together a file that is ready for appeal, that is ultimately ready to litigate. That means making sure you understand what documentation is becoming part of the audit file, because as that documentation becomes part of the file, now those are items that will be that much more relevant as you move it up into an administrative appeal proceeding. And it will be much easier as you transition into potentially litigating an issue around this and for that matter, several of the other topics that we'll be discussing today. And with that, I will turn it over to Jenny to talk about some royalty issues.
All right. Thanks, Kyle. Well, first, I actually wanted to thank Kyle for putting together this webinar series. And second, I did want to clarify that I wanted to discuss indirect audits, not just because of the bar issues, but also because they have an effect on restaurants as well. So important restaurants like Dairy Queen and Culver's. So now that we've clarified that, I'm going to move to talking about royalty payments, and specifically royalty payments that are made as part of a franchise agreement. So typically, franchisors are not as concerned about sales tax issues because it's generally the franchisee who is handling the final sales tax or the final sales transactions. However, this is one area that can affect both parties. And it's very much an area that can turn into a gotcha moment because parties to a franchise relationship generally don't separately itemize out what the royalty payments actually include. And oftentimes, those payments can be for taxable services. So this can result in unexpected sales or use tax liability. Typical taxpayers in this market who may be at risk for this issue include businesses like Famous Dave's or Dairy Queen, McDonald's, and even like a Great Clips. And for these taxpayers, the franchise agreements that they enter into generally address a couple of things. They address the licensing of intellectual property, like trademarks and general know-how. And they also address the obligations of each party. And those obligations usually include some type of service that the franchisors must provide. So, for example, training services to employees or staff. Like most areas of sales tax, taxable services can be very state-specific. Some common and potentially taxable services you may see in a franchise agreement include things like accounting or tax preparation, legal, site location services, inspection services, training, and even things like online help services. So when a taxpayer makes its royalty payments without separately itemizing out these taxable services, this can create a major issue during an audit. An auditor is going to notice that the franchisor is providing these types of services in exchange for a royalty payment, and the concern is that instead of separately itemizing out those taxable services, they're viewing the royalty payment as a whole and subjecting the whole thing to sales or use tax. I wanted to mention really quick that we're focusing on taxable services here because that's generally the gotcha moment. But this same issue can apply with TPP, tangible personal property. So let's use Dairy Queen as an example. You open a Dairy Queen, and as part of that franchise agreement, you get all of the signage that goes in the store. Clearly, that's tangible goods, and someone should be paying tax on it. However, are you really given those goods? Does transfer of title actually take place? Or does Dairy Queen, as the franchisor, maintain title to that signage and just put signage up in your restaurant? Certainly, any portion of the royalty payment that is attributable to the transfer of goods would be taxable. So this is just something to keep in mind when you're dealing with taxpayers in a franchise relationship. Going back to services, the biggest concern that you have during an audit is that the auditor is going to take the entire royalty payment and call it fully taxable. For example, South Dakota, which is a streamlined state, specifically says that when taxable sales are included within a royalty payment and they're not separately stated, that entire royalty payment is going to be subject to a sales or use tax. So who is most at risk for this issue? It's any taxpayer who really falls into that South Dakota example, and really it's anyone with locations in states that tax services. So just as an additional example to really highlight the potential risk, there are some states that tax information and data processing services. States like Minnesota, Texas, New York, and New Jersey, all of these states tax this type of information and data services. So let's say that a franchisor is providing marketing lists as part of the franchise agreement, and they're being compensated for providing that marketing list. Is that compensation now related to taxable information service? Because arguably the marketing list is information. So it's really these types of services that you may not immediately think of as taxable that can get taxpayers into trouble. So the question becomes, how do we mitigate this issue, especially during an audit? So the first thing that you're going to want to do is to closely review what is actually provided in the agreement. So actually pull out the agreement, go through, and identify any services that are provided as part of it. You're also going to want to think about any services that are provided that may not be specifically listed. Once you've got your list of services, you can go through on a state-by-state basis and determine what services are actually taxable in the states that your restaurants or your Great Clips are located in, and separately account for those. You can, as the franchisee, ask the franchisor to separately itemize and collect sales tax on those services. Alternatively, the franchisee can consider accruing use tax on the portion of the royalty payments that are allocated to taxable services. During an audit, one possible defense is to make a de minimis argument. So if you're located in a streamlined state and you've got a non-itemized charge, this would be treated as a bundled transaction because you're getting goods and services for a non-itemized price. One avenue to contesting an assessment in this case is to say the taxable components of this payment are less than 10% of the total value of the franchise fee, and therefore that value is de minimis. So in a streamlined state, like in Minnesota, for example, our de minimis threshold is 10%. So you're going to want to be able to prove that only 10% of that royalty fee is actually on taxable services or TPP, and therefore does not exceed the de minimis threshold. And then finally, as Kyle mentioned earlier, one option is to try and work with your local revenue agencies, in particular trying to reach an agreement so that you have consistency going forward. Some examples are PLRs, advisory opinions, and managed compliance agreements. One example is in Texas, you can reach a managed compliance agreement that is essentially determining an error rate, and you're just carrying that error rate forward. So if you go through an audit and obtain an advantageous result, you may want to say, hey, let's document this result as part of a managed compliance agreement so that we know every period going forward it's going to be treated this way. And then should the need arise down the road, you can put this agreement in front of an auditor. So the message overall is do what you can to itemize out the taxable services. If you're in a streamlined state, consider making a de minimis argument. And then always, consider working with your local revenue agency. And before we move on, I wanted to mention one more thing that I just talked about this in the context of franchise relationships, but the same issues could be applicable in other royalty payment situations. For example, like extraction royalties that are paid and associated with oil or timber or gas. It's possible in those situations that an auditor may attribute the full amount of a royalty payment to some sort of sale of tangible goods or taxable services. So something to keep in mind when dealing with royalty payments.
Yeah, Jenny, I want to add just a couple quick things here. So on the de minimis issue that you brought up, obviously, if you're able to demonstrate that less than 10% in states that have those types of definitions and would try to be taxing the entire bundle, if you're able to demonstrate that less than 10%, that's obviously a good answer. Now, if you haven't tracked what your royalty payments relate to, you haven't actually gone through and determined on a line-by-line item basis what they relate to, that's a very difficult thing to back into when you don't have any contemporaneous documentation. So in terms of just itemizing, that's something to consider is if you're not itemizing up front on that basis, trying to back into that can be difficult to obtain because it's just the optics of it are bad within an audit.
Mm-hmm.
Another type of item here that kind of popped into my head as you were talking is, you know, if you're a franchisor or franchisee and you have a royalty payment issue and the department comes after you and there's no way out of it, you're going to get the assessment. One of the kind of last ditch efforts, and this happens in a lot of different audit contexts, but reach out to the other party. You're in a franchisor-franchisee relationship. You're pretty close to the other party, so reach out to the other party, and perhaps they actually paid the tax already. I mean, the worst case scenario here isn't just one party getting assessed the tax. It'd be if both parties were assessed the tax in the same transaction. And before you give up on it, I would throw that Hail Mary. I would also mention, you know, we mentioned a few different times streamlined in here. You know, working with policy folks to make sure that you understand how their state is interpreting the statutes and applying them to royalty payments, and whether or not that could put some stress on the fact that they're trying to stay kind of in concordance or consistent with streamlined definitions. Something to consider. And then just in terms of what is taxable, don't always just accept that because something looks like a taxable service, it is a taxable service. Is there a way that you can characterize something that's being provided as not fitting within narrowly defined and enumerated taxable services? And then finally, I would say if your royalty payment's getting taxed, and especially if your royalty payment is getting taxed as a bundle for providing things like taxable services or goods or whatever, make sure you're not paying tax on your inputs. Several different states will have, you know, statutory positions that allow you to, say, exempt inputs into providing taxable services as manufacturing equipment or purchase items exempt for resale. Now, obviously, that's super state specific, but make sure that if you are getting charged tax on the back end, the sale of the franchisor, that royalty, that the inputs you're using to deliver what the state is defining as taxable, you're getting refunds on those items. So there's even in troubling times, there can be a silver lining, I guess is the point.
Mm-hmm. Okay. Our third polling question is, how is your organization primarily handling certificate issues?
Polling will end in 5 seconds.
All right. Well,
Okay.
We again have a mixed bag. I'm really glad that as we're transitioning into our next topic, which is exemption certificates, we didn't have 100% sitting at not an issue because that would have made it a little bit awkward for the next moment in time. So obviously exemption certificates, if I got on here and said, we have a novel issue to talk about, and that is exemption certificates, I think most people would probably just disconnect and stop listening. So I'm not going to say that, but what I will say is that although this isn't a new issue, it's a growing issue despite the fact that it's always kind of been present. It's growing as a result, you know, of a couple different things. I think the biggest one is obviously that as a result of economic nexus statutes, you know, being in place in almost every state at this point, you have more and more pressure on taxpayers who previously would have just said, I don't even have a connection with the state. I don't have a nexus that requires me to collect and remit tax in the first place, much less to collect and monitor and maintain my exemption certificates. So as that has come up, more and more companies that historically haven't been all that concerned with exemption certificates have had to start looking at what they're doing on a state-by-state basis. How much, like, what does their sales volume or their sales numbers look like within a specific state, and do they now have to get exemption certificates to cover it? So if you think about, you know, a hypothetical example is a wholesaler. That wholesaler is going to be making sales into a number of states, some of which they previously may not have been filing it. Now they have to file, but they're not selling anything taxable. They're selling everything exempt for resale. Well, they don't have to put taxable sales on their return as a result of having access in the state, but they do have to monitor the certificate issue, yeah, I would say in the vast majority of states at this point. The other issue that we've seen pop up related to exemption certificates is within the drop ship space. So bear with me, I just want to kind of back up a second to talk about drop ship transactions for those who may not be familiar. So drop ship transaction, you're really going to have three parties to that transaction. You're going to have your retail party. That's the party that's making the sale to the actual end consumer. And then you're going to have a drop shipper who is the party that holds the inventory, will transfer that inventory in title only through a flash title transaction to the true retailer, but will actually ship the inventory directly to the consumer. So the three parties, again, your retailer, your drop shipper, and your consumer. So the certificate issue that comes up in this situation is that flash title transaction that took place between the drop shipper and the retailer. That is a sale for resale. So drop ship entities in this situation need to be collecting, maintaining, validating, all of those things related to that transaction, exemption certificates from the retailers. One particular thing I would just point out is that this is something that varies by states, and some states are much more difficult than others. California is kind of the poster child for being difficult, perhaps most so in the drop ship space, maybe in other areas too, but in the drop ship space, if I'm a drop shipper and I am, transferring title to a retailer who has California nexus, then I need to get a certificate from that retailer. However, if the retailer doesn't have nexus, then the drop shipper is actually the party that needs to collect and remit the state, because the retailer can't provide a retail certificate in a state that they're not doing business. So a very kind of peculiar issue in California, very specific to the state, but something to be mindful of if you're working within the drop ship space is the certificate issues that come up as part of it. And I would also add that as it relates to the drop ship issue in California, there's also price differences. Now, if a retailer sells and has nexus and has the responsibility to collect and remit because they have nexus, they obviously know the price that they're selling at. However, if the drop ship is the party that has to collect and remit tax as a result of the retailer not having nexus, the price is different, and they may not know the price that the retailer sold to the end consumer. So what would happen in that situation would be that the drop ship entity would have to take their wholesale price to the retailer and inflate that by 10%. So I kind of digress and go down a rabbit hole here, but there are issues related to exemption certificates, and this is an area, especially as the volume has kicked up, that auditors are more and more focused on throughout the audit examination process. So again, what do we do about it? First and foremost, as it relates to drop shipments, know the drop ship rules. If you are a drop shipper or if you are a retailer that's engaging in drop shipments, know the rules in the states that you are operating, because those things will come up, and that's a bad surprise to get as part of an audit, especially in California, is that you were doing things wrong originally. So understand the rules, understand how those rules impact your business. Second is really take the time to evaluate, and this is broader, not just in the dropship space, but evaluate where you have nexus. Because if you have nexus in a state and you're filing returns in the state, you are at risk to come under audit examination. And one of the first things an auditor is going to focus in on if they see that you have exempt sales, or exempt purchases for that matter, is why are they exempt, and do you have the documentation to legitimize that exemption? So regularly evaluating where you have nexus and making sure that your certificates are in place and up to date within those states is critically important. I'd say third, focus on using technology if at all possible within your organization, and understanding that some organizations going out and buying software to manage this type of stuff is just not possible. But to the extent that it is, this will save an incredible amount of time at multiple points within the collection and maintenance of those certificates. Is it going to be perfect? No, but having technology in place that will help you in validating certificates and alert you to when those certificates are expired or going to be expiring so you can go out and get a new one is an area that can be of huge help to organizations. Work with your customers. So if you are under audit and you're having difficulty obtaining, or coming up with a certificate that you had on file, most states will allow you, as part of the audit process, to obtain a certificate, an exemption certificate, within a specified amount of time of request by your auditor. So having contacts within your customers or knowing people that have contacts with your customers to get those certificates is one potential option. And I would say if you can't get the certificate, if they don't think it was an exempt transaction, have your customers show you or validate that they paid tax on that transaction. Maybe not sales tax to you because you didn't charge it, but perhaps they self-assessed use tax on it, or perhaps they were assessed as part of an audit. Validating that type of tax payment already is a way in which you can mitigate that risk or reduce your assessment within the audit. And then finally, work with your auditor on developing a sample plan. More and more, we're seeing large volumes of certificates requested as part of an audit. Just because you have a huge volume of customers that are exempt doesn't necessarily mean that you need to document every one of those. If you build a working relationship with your audit exam staff or their superiors if necessary, to say, look, in my system, we're categorizing wholesale transactions in a certain way. We can identify all of the wholesale transactions. Here's a large volume of that type of transaction. And we can validate, if you select a number of different customers to show the exemption certificates for, we can validate that we can provide those certificates upon request. But let's do it on a sample basis rather than trying to document each and every one. Now, is this approach free from risk? No, because if that's the route you go and you don't have certificates for some of those selected sample items, if you will, your conversation could quickly turn. So I think before you do something like that, you better make sure that you feel pretty good about your certificate situation. But that's definitely a way in which you can save yourself, if not risk and real dollars, you can save yourself a heck of a lot of time in defending an audit. With that, I'll turn to Jenny to talk about some documentation.
All right, so kind of jumping off of exemption certificates, I'm just going to briefly talk about the importance and kind of the annoyance of proper documentation, especially so that down the road you can validate the tax decisions that you've made. Like everything, this is a very state-specific area. However, across the board, we're seeing states requiring more and more documentation to prove out results that are favorable to taxpayers. So I'm going to focus on a couple specific examples. The first one is MPU, multiple points of use software. How you actually prove out locations of where software is being put to use is becoming more and more difficult. For example, you have software being sent to one central location where a master license is sourced, but then that software is subsequently distributed out to users around the country. And how do you show that to an auditor? So let's say in Minnesota, you're only accruing use tax on 5% of the software purchase price. How do you defend this allocation? You do that by providing adequate documentation that shows when you made these decisions that contemporaneously you're sourcing this 5% based on, say, user headcount, and that across the country you're consistently using this type of business record to source your software, and that you're accruing use tax in Minnesota in accordance with these business records. The same thing can be said with direct mail. In that case, you have direct mailed shipped throughout the country, but then you have an invoice that says shipped to Minnesota. So everyone knows you didn't purchase 5 million letters to go to Minnesota. They're being shipped throughout the country. The question is, what is the best way to document the situation, and what can you say to an auditor? Again, the focus is on providing exemption certificates, like Kyle just mentioned, and providing contemporaneous documentation, which shows, you know, this is the group that the mail was sent to, and this is how we accrued use tax as a result of this. And if you don't have this type of documentation, it can be a big risk on audit. A couple other quick examples. Obviously, there's some similar issues surrounding bad debt and documentation. Additionally, taxpayers that take location-based exemptions, like credits and incentives, are going to want to be sure to timely acquire their exemption certificates or become certified, and then to make sure that they're reapplying for those certificates, like Kyle discussed just now. Some examples are, like, North Dakota has a primary sector exemption. If you become certified as a primary sector business, you have the ability to not pay tax on otherwise taxable goods. Same thing with Kansas. They have the high performance incentive program. Georgia has the high tech exemption. The important thing is that in any situation, you get your documentation in order, which means getting your certificate and making sure it covers the periods that you're trying to apply it to. So just because you have a certification 1 year does not mean that a state is going to simply agree to carry it forward for all future years. So the taxpayers who are most at risk are those who deal with MPU issues, direct mail allocation, bad debt issues, and, you know, taxpayers taking certain exemption claims on a state-by-state basis. The best way to mitigate documentation issues is to make contemporaneous and consistent allocations with respect to MPU and direct mail. So, for example, with MPU, states like Minnesota, Ohio, Washington, Massachusetts all have an MPU exemption, meaning you only pay tax on software if it's actually distributed to users in your state. So one example is, let's say you have a $100,000 transaction, and according to a contemporaneous user report, 10% of my employees are in Minnesota. Therefore, I'm going to attribute 10% of the transaction to Minnesota. As long as you're using a contemporaneous and consistent records across the country to make that allocation, it's going to be looked upon favorably by the states. And the same thing goes with direct mail. If you have a bank, let's say you're a bank, and you have check deposit slips and leaflets that you hand out at each bank branch location, and the way you decide to allocate out that cost is by saying, okay, I'm in Minnesota, I'm going to use my Minnesota branches over all other branches in the country. So even if I end up with an order that 100% of it goes to Minnesota, but I'm only paying tax on 10% of it, if the same thing happens the next month, 100% of that order goes to Kansas, and I'm still paying tax on 10% of it in Minnesota. As long as you have that consistent approach, states are going to look upon that much more favorably. I'm just going to rush through this really quick because we're getting a little short on time. One obvious recommendation to mitigate documentation issues is just communicate with your vendors and ask them to include ship to locations on their invoices. You can use alternative documentation like sourcing IP addresses. That's something that you can talk through with your IT friends to help you with that. And then the other thing is working with your state policy people. And Kyle's mentioned this several times already, but when you have an auditor who may be trying to take an approach that you think is inconsistent, perhaps, again, I'll use a streamline example that may be inconsistent with a streamline approach, and you're not getting anywhere with that auditor, there are other people in the department who are willing to help. So chances are, if you raise that sort of policy question to someone within the department whose job is to enforce policy decisions, you may see a change in your auditor's position.
I'm gonna just step in for a second here. I know Jenny was trying to move quickly so we don't miss stuff, but I'm willing to sacrifice some of the time I'd spend sounding off on miscellaneous issues in order to mention a couple quick things. So first, like on the multiple points of use software, one thing that's that's interesting to check out is, Minnesota's MPU statute that, allows for sourcing in that manner, requires that you provide an exemption certificate for MPU purchases at the time of purchase. Now that's different than other streamlined states in terms of that requirement that it be provided at the time of purchase. This issue was actually litigated, whether MPU could be a refund opportunity in Massachusetts recently, and that's an item that came down to the taxpayer's favor. So in terms of just documentation and documentation risk on MPU, if you're, if you want to pursue, being able to only pay tax on the users that are in Minnesota and take advantage of, say, users in non-taxable states like Illinois on software, get the certificates out at the time that you purchase it. And I understand that's easy to say here, but monitoring transactions on a monthly basis and getting those things out timely is another story. But you're going to have way less of a fight if you're under audit and that certificate was provided at the time of purchase than if you're, trying to, get a refund on that type of position. And with that, I'll give it back to Jenny.
All right, I think we have our fourth polling question here. How long does an average state tax audit last for your organization?
Polling will end in 5 seconds.
Okay, so it looks like we have some fairly efficient auditors. I was
like, well, these people are way better at getting things through than I am.
Yeah. So one thing I wanted to comment was, we harp on documentation not just because it improves your chances of success, but it also can increase efficiency during an audit, although it looks like a lot of you are pretty efficient. So we'll move to the next topic. And this last topic, or second to last topic, I think most of us are familiar with the technique, but an indirect audit is something that I think is becoming more and more common among state revenue agencies. For example, in Minnesota, a recent Supreme Court case actually confirmed that auditors can use an indirect audit if a taxpayer's books and records are inadequate or incomplete or unreliable. So what's really concerning about indirect audits is that auditors are using circumstantial evidence to reconstruct sales, and they're making assumptions that can be very damaging to the taxpayer. And yes, this does usually apply to bars or restaurants. And a lot of that has to do with just kind of the nature of the transactions at bars or restaurants, just kind of a general lack of documentation, sometimes archaic POS systems, and then just having limited resources to put into actually tracking purchases and sales activities. If you follow any sort of tax opinion reporting service, almost on a monthly basis, you're going to see a decision where a bar or restaurant gets rung up on tax for inadequate documentation. So the idea is that taxpayers must have something that provides their version of the facts. Otherwise, auditors will be able to use their version of the facts that's to their best interest, and you really don't want to end up in this situation. So one example of this is like a Dairy Queen, and there was actually a case in Minnesota at the tax court a while back, and in that case, the auditor took one of those plastic ice cream mix bags that's about a gallon size, and using that bag, he determined how many sales could be generated out of just one bag. So if Dairy Queen had vendor invoices showing it purchased 10 bags of ice cream, then from the auditor's perspective, they should have had a certain amount of taxable sales. Same thing happened in Conga, which is that Supreme Court case I mentioned. The auditor took a 25-ounce bottle of vodka, for example, and said, okay, if each drink has 1 ounce of vodka in it, this one bottle of 25 ounce bottle should have produced 25 drinks. And there's a lot of concerns with this because it doesn't consider things like spillage or free drinks or specials. And so the auditor has to make assumptions. And then finally, the auditor is going to use their indirect results and extrapolate that over a larger time period. So Kyle mentioned doing like a sampling and some of the steps to consider, analyze when taking that approach. And in an indirect audit, you're going to want to be very careful with what you agree to in terms of sampling. So how do we mitigate this issue? It goes back to the documentation. You know, keeping contemporaneous records is always the most important thing that you can do. Now, I know that resources can be limited. Sometimes doing like hiring an inventory service to actually come in and measure, you know, if you're at a bar, measuring how much alcohol is left in the bottle at the end of, you know, a week or something, that sometimes can help. I've seen it used at the tax court before. It actually helped improve the credibility of one of the bars that was under audit. And then the last thing I mentioned on here is something that it really depends. Every business needs to properly think through what the best answer for them is, but the question is, what sort of access do you want to give the auditor? One way to save time, hypothetically, is to allow an auditor to have remote access to your point of sale records, but you know, you also have to be careful because there's a balance between giving complete access to an auditor, and then you may have a somewhat rogue auditor who will do any number of things given complete access. So I'm going to turn it over to Kyle for our final topic.
All right, so we're wrapping up here, but there's a few different items, just miscellaneous items I wanted to touch on really briefly. So we previously talked about, you know, this issue of using gross sales as, you know, a potential number that auditors can tax. So I'm not going to belabor that anymore. A couple things that are just crazy to me that I've heard of recently are auditors trying to bring subsidiaries into an audit. And sometimes, you know, this is because the data that was provided to them includes subsidiary data. But sales tax is an entity-based tax. I mean, with very limited exceptions, there aren't the concepts of disregarded entities don't exist here. So if an auditor tries to assess a subsidiary within your audit, that's just not permissible. So don't allow that to happen. If they want to audit that entity, then audit that entity, but certainly don't allow them to assess a subsidiary, and certainly don't allow that to come into a sample and then project across the actual entity that's being audited their population data. And then the other thing that's fairly egregious that I've seen recently is auditors trying to bring data in from outside the sample period. So if you have a sample and projection, they need to stick to the sample period as they're evaluating this. So, you know, just a couple random things that have come up recently in terms of mitigating it. Again, I'll go back to working with your Department of Revenue and the different avenues that are available within the department. And I would just add to that, information requests are not always legitimate. Information requests, IDRs provided by auditors can be objectionable, so object to them if they're objectionable. So don't be afraid to tell an auditor that you know this is just something that you don't believe they're entitled to, or have your representative tell them. In some cases, they may take that off the list. In some cases, they may have an interest in it that you might not have contemplated. So figure out what it is that they're trying to get to that information to achieve. Perhaps there are other avenues to provide information that will be equally helpful for the auditor, but will be easier for you to obtain. And with that, we're at our fifth polling question. Our fifth polling question asks, what is your company's policy surrounding pairing refund claims with audits?
Polling will end in 5 seconds.
All right, so it sounds like we've got a kind of evaluate the issues and figure out if it makes sense. I would say one thing, obviously, if you're going through an audit and you can get credits within the audit or refunds within that audit, there's, not only do you have the advantage of not triggering an audit because it's already there, but you also, in some states, have an interest benefit as well because you're offsetting interest rates which may be larger or only relate to assessments. That is our presentation today. So thank you all once again for joining us. A quick reminder to use your evaluations to submit suggestions for future topics and to join us again on June 11th when Ken Levinson and David Tibbles will be discussing the state income tax issues arising from international tax reform and the Federal CARES Act. Finally, have a fantastic weekend. We will talk with you all again soon.